Mutual funds are a revolution in investing, or at least they were back in 1924, but that doesn't mean they can't still be a part of your portfolio. In this video, I'll give you a step-by-step to mutual funds, what they are, the pros and the cons, and alternatives for your money. Then I'll reveal the one and only scenario when you should be investing in these. We're talking Mutual Funds Explained today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now nation, if you wanted to invest before mutual funds, way back in 1924, you had to buy what was called an investment trust. You'd pay up to a 10% fee off the top and as much as 12.5% a year just for the company to manage your money. That year, the world's first mutual fund was created, though, giving investors the ability to buy and sell their shares in the fund at any time, starting with an investment of just $250 and a 5% sales charge. This was revolutionary, and it enabled millions of Americans to start making their money work for them, and more than 70 million people have invested through mutual funds since. But are they still a cure for Main Street investors, or is there a better alternative? In this video, I'll explain mutual funds and show you how they work. I'll walk you through the mutual fund basics, the pros and the cons, then compare funds against stock investing and ETFs. Then I'll reveal why you might think twice about investing in mutual funds and why they're a little like using a horse-drawn carriage to race a Ferrari. First though, I want to throw this out to the community. I'm trying to do more investing educational videos here on the channel, and I want to know, what are your questions about investing? What do you want to know about investing to make your money grow? So scroll down and let me know in the comments below so I can put a video together just for you. So what is a mutual fund and how do they work? Mutual funds are actually legal companies, technically an investment company pooling your money with other investors to buy shares of individual stocks, bonds, or other assets. The company hires an investment manager that follows the fund's specific mandate, like only investing in large company stocks or only buying bonds of highly rated companies. The fund might also have an objective like growing the investment value or spinning off that steady cash flow. And there are different types of mutual funds depending on what they invest in. There's funds that invest exclusively in stocks or bonds, or others that do both. Some invest in ultra-safe money market bonds as an alternative to cash savings, and still others invest in commodities and alternative investments. For this professional management, the fund charges a set of fees to investor accounts. The most common here is this expense ratio, or it might be called a management fee, and averages about 1% for mutual funds. Now this one covers those day-to-day operations of running the fund, paying the manager and other staff. Another fee you might see on your mutual fund statement, the 12B1 fees. Now these are capped at 1% and help to pay the cost of marketing and selling the fund, plus some shareholder services. If you're lucky, that's going to be all the fees you pay, around 2% of whatever you have invested each quarter to cover those management and the 12B1 fees. But most mutual funds also charge what's called shareholder fees. Those fees usually include what's called a load fee, which is a commission paid to the salesperson that sold you the fund. Now these can be front-ended, where you pay a percentage of your money off the top, or a back-end where you pay a percentage when you sell the fund. Now these can be as much as 5% of your money. So for example, investing $100 in a fund with a 5% front-end load fee means $5 of that goes to the salesperson and you get $95 worth of the fund. Another fee here, there might also be a redemption fee charged if you sell the fund within a certain period after purchasing it, something that could be anywhere from a few days to even as long as a year. And finally, the fund might also charge an account fee. This is kind of a catch-all charged on accounts under a minimum balance or ones that don't meet requirements to deposit every 3 months. Now, I don't want you to get the idea that all mutual funds are going to charge you an arm and a leg to invest, but you absolutely have to ask for a list of these fees before you buy into any fund. And mutual funds do carry all kinds of benefits and have truly revolutionized investing for millions of people. Funds give you instant diversification. With one share of the fund, you get exposure to hundreds or even thousands of stocks and bonds. And that gives you the safety and the stability that's just hard to get buying individual stocks. Funds also give you that access to professional management. Now remember, this was before anyone could just click through and get the best investing idea and watch a guy that rocks a bow tie. Mutual funds offered Main Street mom and pop investors to join the ownership class, invest their money, and meet those long-term investing goals. Now before we get to the drawbacks in mutual funds and compare them against some of those other investments, If you want to stay up to date with the most important investing news, trends, and strategies, sign up for the Daily Bowtie, my daily market newsletter. It's a totally free newsletter, just a way I like to help all you out there in the community stay up to date with the market. I'll leave a link in the video description below. Click through and don't miss out. Now, as we say here in the nation, it ain't all rainbows and unicorns though, and there are some drawbacks to investing in mutual funds. The most obvious here, of course, are those fees, and with some mutual funds costing you as much as 2% of your money each year and then 5% off the top when you buy. In fact, when we compare mutual funds versus exchange-traded funds later, I'll show you how to save almost $200,000 in fees just by using ETFs. Mutual funds also aren't traded like stocks throughout the day. Instead, they trade at the end of the day and for one price, but you're not going to know that price you're getting until the end of the day. And as bad as all that is, the biggest drawback to mutual funds is that you pay taxes on the investment every year, whether you sell your shares or not. Mutual funds distribute capital gains each year, and you get taxed even if you're holding on to that investment. So now, with all those drawbacks, I still do like mutual funds versus stocks in some situations. As we saw, the funds give you that opportunity to immediately diversify your portfolio without really buying a bunch of individual stocks. You get professional portfolio management and don't have to worry about your investment. But remember that race between the carriage and the Ferrari? Well, the Ferrari is those exchange-traded funds, the ETFs, and it's been smoking mutual funds ever since 1993. ETFs were actually created to fix a lot of the problems that we see in mutual funds. It's the same basic concept, a fund of investor money directed by a portfolio manager according to a mandate and an objective. Where mutual funds and ETFs differ, though, is hugely important. ETFs do trade like stocks, so you can buy or sell throughout the day, getting an immediate price. You only pay taxes on ETFs if you sell the shares or receive a dividend, and best of all is the cost. ETFs charge an average expense ratio of just 0.5%. That's half the average fee on mutual funds. Now, there's also no account fees or sales charges for buying an ETF. And to put that fee difference in perspective, the graphic here shows how those fees add up to over 30 years of investing $5,000 a year. The green line, over $200,000, is how much you'd pay investing in the average mutual fund. The red line, though, just under $46,000, is the fee on the average ETF. And the blue line here, less than $11,000 in fees over 30 years, is if you invest in some of the least expensive ETFs, those sold by Vanguard. Wait, don't click away. As much as I do like ETFs over mutual funds, and I'll link to a video on how to invest in ETFs in the video description below, but sometimes you might not have a choice, and there is one situation where I would go with mutual funds instead. Nation, the tragic fact is that a lot of workplace 401k programs are still based on those mutual fund providers. Companies need someone to manage their 401k programs, and these mutual fund companies are more than happy to help because of those huge fees they can collect. Even after all those fees though, after the management fee, the account fees, and all the others, if you're getting a company match on your 401k contributions, investing in the program is still going to be a great deal. Even against the downsides of mutual funds, and there are a lot, getting that free matching money from work is the best investment you're ever going to make. So definitely don't miss out on that. Click on the video to the right to see how many shares of stock you need to invest to make $1,000 a month. Exactly how many shares in stocks like Apple, Disney, and Ford. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.